Hey guys, and welcome back to the Young Investors Podcast. This is episode 46. We're almost at the 50. We're getting
almost there.
One more month, and then we'll be at the 50. Joining me, as always, is Brandon. How's it going, Brandon?
Hello. I'm going well. Yeah. Excited by how well Australia's doing in the cricket at the moment.
Yeah, it's been good to watch. Yeah,
it has been good to watch. Yeah, although I stayed up a bit last night and I went to bed before we got the next 3 wickets. So I was like, oh goddamn.
Right. Yeah.
Yeah, it has been good to watch. I love watching the Ashes. It's great. What a contest. Usually I say with the Ashes that it's just whoever's hosting the Ashes series will probably win it.
Yeah.
So it's been really surprising that that we've actually done decently. Well, definitely. Really, when I say we, I mean Steve Smith.
Yeah, I was going to say, it's just a one-man effort.
It really is. And the Australian lineup, it's Steve Smith, and that's it. Get him ripping out his leggies, he could bowl as well.
Yeah,
anyway,
very true. No, it's,
welcome back to the cricket podcast.
Yeah. We always start by talking about something completely unrelated to investing.
Yeah. Well, usually it's the weather. At least we've strayed away from the weather now.
Yeah.
Although, how is the weather going down where you are?
Dude, the weather's good. Actually, temperature today is 18 degrees with a blow of...
What's the chance of precipitation? Canberra weather. Let's have a look. It should be pretty good here. Oh, look at that. 9 degrees.
Lovely.
Love it. That's actually like not too bad.
No, but
stay sunny.
Yeah.
Sorry.
No, but yeah, we should get into this because there's probably some new people listening to this thinking, "What the hell have I just clicked on?"
What have I clicked on?
We are going to get to some investing and finance stuff. So today we're going to talk about some of the indicators that suggest that a recession might be coming. So everyone's kind of screaming about a recession, or some people are saying, "Calm down, there's going to be no recession." So I thought it'd be nice to talk about some of the indicators that people are kind of pointing to say that yes, there is something coming. So we're going to talk about that. We've got a bunch of news stories. We'll talk about Tesla and a bunch of other things. Of course, we'll talk about Tesla. We always do. And of course, we've got some Q&As towards the end. So if you have any questions that you want answered on next week's podcast, then head over to the YouTube version of the podcast. That's on my channel. youtube.com/Hamish Hodder. Leave a question and we'll get to as many as possible in next week's podcast. But with that said, do you want to run us through the indices?
Yeah, sure. Dow in America up 2.02%, S&P up 1.4%, Nasdaq up 1.1%, so decent week over in America. Here in Australia, a little bit less than that. ASX 200 was up 0.65%, and the All Ordinaries were up 0.8%. So there you go. Although it has been decently turbulent, even though we just see the markets going up over the last week, has been a fairly turbulent time in the markets, mainly thanks to the old Mr. Donald T. Rump, which I'm sure we'll talk about in just a little while. But any surprises with the markets?
Nothing really in particular. I've just noticed that, like you say, it's been a little bit more volatile recently. That's the one thing that I've noticed. We were seeing a few weeks where there was kind of no activity really in the market for a while, but now we're seeing some big ups and some big downs. But again, I mean, nothing too exciting.
There's been a couple of kind of like down or up 3% kind of days, but like you say, nothing critical, nothing too exciting. Yeah. So with that said, do you want to get started with the news?
Yeah, so the first news story that we had here is about Porsche. And so Porsche, they revealed I believe it's their first electric sports car, correct? Or their first electric car that they've produced. And it is the Porsche Taycan. Am I pronouncing that correctly?
It's pronounced Toucan.
Toucan, is it?
No, it's not. I just call it the Porsche Toucan.
You could have honestly told me that it was Toucan, and I would have spent this entire podcast saying the Porsche Toucan.
Calling it the Toucan. Nah, I don't know. I think it's just like Taycan.
Yeah, I think so. Yeah, no, and I guess it's kind of one of Tesla's first major competitors, I guess, but in some ways not really. I mean, it's a sports car, so I guess it would compete more directly against the Roadster, I guess. But I mean, it's a big car manufacturer that's coming out with this, and did you want to run us through some of the spec comparisons between maybe some of the Tesla cars and the Porsche car that's just been released, so we can get some baselines?
I found it really interesting because you you do look at more of the price of the Porsche that they've announced, and you do think it's more of a comparison then between the Taycan and the Roadster, because the Porsche is just so expensive. But in terms of specs, it's actually much more realistic to compare it to the Model S. And this is the interesting thing that I found. I actually watched a video yesterday on the Hyperchange channel, which is run by Gally, and he did a great video just breaking down the whole situation with this Porsche electric car. Because on paper, this is going to sound crazy, but they've got that. Okay, so they've got two versions of this Porsche. They've got the Porsche Taycan Turbo and then the Porsche Taycan Turbo S.
Can we just take a moment to appreciate that they're calling it a turbo when there's clearly no turbo in it?
There is no turbocharger. Yeah. It's ridiculous. And I think Elon actually made a tweet about that saying, like, lol, Porsche, I don't think you understand what turbo means. But yeah. So what was I saying before? That's right. So when you look at the base model of the Porsche Taycan, the starting price is $150,900 US.
Wow.
So it's very expensive, obviously. But then you start looking at the range, and the EPA range is only 233 miles on the base model. Which this is where it gets interesting, because if you compare it to a normal standard Model S, or actually no, sorry, if you compare it to a Model S Performance, you get 345 miles of range.
Wow.
So 345 versus 233, so there's a big discrepancy there. And the current Tesla Model S Performance only costs it costs $100,000 US instead of 150, which is crazy. Then if you look at the 0 to 60 times 0 to 60 miles per hour, the standard Porsche Taycan takes 3 seconds, the Tesla takes 2.4. Then the quarter mile, it'll do it in 11.1 for the Porsche and 10.6 seconds for the Tesla. And there's also less cargo storage in the Porsche as well. So if you compare the standard model to the Tesla is just absolutely destroying it. It destroys it in every performance metric, and it's $50,000 US cheaper.
Yeah, it's it's kind of crazy. You pay 50% more and you get almost 50% less in range.
Yeah.
But I guess, I mean, the Model S it's still by far probably the most, I guess, everyday driver worthy electric car, I would say, just because of how much extra space they have, and the range is just unbeatable.
Yeah, besides the 3.
Yeah, so it'll be interesting. I don't know a whole lot about the new Porsche. I watched a couple of videos on it. I thought it was quite cool because
it looks good.
I really like Porsche's how they design their cars, and I think it looks really good.
Yeah, it looks flash.
And I mean, I don't think it'll do. It really bothers me when people say the term Tesla killer, or saying that it's going to flop. I think both of those are I think there's room for both cars in the market, and I think that there's a lot of Porsche enthusiasts who will get around this. And I don't think I'm not sure. It'll be interesting to see if it flops or not. It certainly won't kill Tesla. I think that's pretty obvious at this point.
Yeah, I mean, when you just think about just car manufacturers in general. I mean, this Porsche, you're literally right. It's 50% more expensive for like 50% less range. So obviously, it's for most general people. I mean, even like there's the Model 3. So for most general people, they probably buy a Model 3, which is cheaper again anyway. But even if you compare just the Model S to the Porsche, I mean, from how we look at things, where we're always looking for value for money and that sort of stuff, it's obvious that the Tesla is better. But of course, you also say that Porsche has a bit of a brand kind of moat, in that there will definitely be people that buy the Porsche because it's a Porsche and it's not a Tesla, it's a Porsche. And it's got those, as you were saying, those classic Porsche design cues and that sort of stuff. So
the other thing to mention, I just remembered, was that when you buy a Porsche, it has less range. These cars have less range, and they also don't have access to the Tesla supercharger network. I think there was a lot of people hoping that Porsche would do some kind of deal with Tesla to allow their cars to use the system, because I was watching one of MKBHD's videos. He's a Tesla he's very obsessed with Tesla, and yeah, he was just talking about how when he drives his Tesla, he really doesn't have to think about, in the US at least, he doesn't really have to think about charging because there's superchargers everywhere along the coast. Yeah. Whereas with a Porsche, you'd kind of, if you bought this car, you'd probably constantly be worrying about where your next charge is going to be, and that's something you don't have to worry about with the Tesla.
That was interesting as well because one of the draw cards that they put for the Taycan was that it can charge faster than a Tesla. And on paper it can, definitely. But it still begs the question, well, okay, where do I go to get those charging speeds? I mean, if it's not charging at a Tesla supercharger, like where is it charging? You're not going to get those charging speeds out of your wall socket at home. Yeah. Or in your. So you're right. They do put that on paper. And there's interesting things like to get that spec with the faster charge, to actually be able to say, yes, this charges faster than a Tesla. They actually have to make the battery slightly bigger than the Tesla. So, increase battery size, more cost, higher cost of the battery. It just keeps making it more expensive. So they kind of, in a way, they're just making people pay more to get that kind of charge speed. But it's just interesting that that even the specs don't hold up. And the most interesting thing, I don't know if I've mentioned this yet, is that the 2020, the Porsche Taycan that's coming out, actually the standard version doesn't beat a 2015 Tesla Model S P85D. Yeah. That is with ludicrous. So what's crazy is this Porsche's 150 costs $150,000 US. The 2015 Tesla Model S was 115. And then in terms of range, the Porsche gets 233 EPA miles of range. The 2015 Tesla got 253. So 233 versus 253, it still doesn't beat it. And it's 4 years, or it's going to be 5 years difference. So pretty crazy. But yeah, I thought that was pretty interesting.
Yeah,
so
definitely.
Kind of like the first big, I suppose, big effort or car that can really go up against the performance Teslas like the Model S. Yeah.
Absolutely. And so the next news story we had, which we sort of touched on before, which was this sort of trade war just continues to boil over.
Keeps raging.
Yeah. So there's more tariffs that are coming out now. China began to impose some additional tariffs on some of US goods. So you might remember last week we spoke about Trump and the US imposing some more tariffs on China. And here's China coming back once again on US goods of worth $75 billion US dollars, which is about 111 Australian dollars.
Yeah.
And these tariffs are essentially an extra 5% and 10% that are levied on 1,717 items of a total of 5,078 products originating from the US.
It's a decent amount of products. Yeah. And so that's a retaliation from, I think, the new tariffs that the US announced got implemented on the 1st of this month. So it sounds like it's been basically a straight up immediate retaliation. But I mean, we were talking about this off air before, the way that we see it, it's just like what we're talking about, just seems like these tariffs, this trade war, it just doesn't really help anyone. Yeah. It just doesn't seem to help anyone. I mean, at the end of the day, it makes products more expensive. If you put import duties on, say if you're in the US and you put import duties on Chinese goods, then it just gives the US manufacturers leeway to increase their prices, which they will do, obviously, to make themselves more profitable. So it really just, for the end consumer in the US, it just makes everything more expensive.
Yeah, it's kind of just like adding a little bit more of a bottleneck in the free market. There's a little bit more cost, a little bit more money that's not really going to the business that created the product or savings passed on to the consumer. It's kind of just going to these governments who are just in this fight between each other. And I mean, it doesn't benefit anybody. I wonder when, or if, I guess maybe we'll start to see it soon, that this will really flow over into increased prices, into inflation, because we still really haven't seen any inflation, which is insane to me because of how much printing of money and buying of assets that the US Federal Reserve has done, plus these tariffs. All of that is inflationary pressure, but we really haven't seen it come through in the data, which, I mean, it'll be fascinating to see if it ever does and when it does. But I mean, there's kind of not a whole lot more to talk about this. I mean, we've kind of been speaking about tariffs for pretty much every week for 2 years.
Yeah, literally. I'm pretty sure we have, like, the first podcast we did, we probably talked about tariffs. It's just been continuing, and it just gets a little bit worse and a little bit worse and a little bit worse. But I agree with like what you were saying before. I just, from my fairly uneducated opinion, I'm not an economist. I don't know the ins and outs of the import duties and that sort of stuff. But just seems like at the end of the day, no one really wins. I think that in terms of growing your economy, you want to be friendly and trading with as many external countries as you possibly can, whether it be like the US or China. Sure, China might export more goods than US, but I just think in general, like you can kind of apply it to the same, like you by yourself earning, like you as an individual earning one salary, you can do, minimal amount with the money that you've got. But if you had a partner and you guys are now all of a sudden working with two salaries, you can do a whole lot more kind of thing. Like I just see that from my fairly uneducated opinion on this topic, it just seems like there's much more benefit in everybody working together as opposed to saying, nah, we're exclusive, we're better, we're going to put these taxes or import tariffs on you, and we're going to kind of hurt our national kind of relations, I guess, our global relations with these different countries. It's just, I don't know.
Yeah, we will see. We will see what happens. And then the final news story that we had for today, a little bit of a short one, is Coles. So Coles is now offering free online delivery. Which is,
I can take us through this one if you want.
Yeah, go for it.
So basically, this is just a follow-up because we talked about it last week, I think it was, when we were talking about how the supermarkets are increasing their online delivery services and getting more profitable in that region. But we were talking about how it's not increasing their profitability. It's actually costing them money to make this service better and better because of the inefficiencies in their delivery systems. But yeah, I found it was interesting because I think it was Woolworths that was saying, hey, look at us, we're doing so well, look at our online shopping. And Coles has basically just had a response that they're now offering free online shopping delivery for the rest of September. So the article reads that the supermarket war is edging closer to an online war as Coles announced on Friday customers will get free delivery for the rest of September. The offer is more of a boast by the major supermarket, which said the discount was to celebrate the 30% rise in online sales over the past 12 months. So basically the details are the customers who ordered groceries totaling more than $100 to their home won't pay a delivery fee, while click and collect shoppers will get a $10 discount if they spend more than $150 before and order before October 10th. So kind of interesting. Again, it's just like what we were saying last week. I mean, this is kind of like a non-story because I think at a fundamental level, the supermarkets have to change the way that they're implementing this online delivery service to make it more profitable for them. They have to find a way to drop the cost of offering that service.
Yeah. I mean, there's not a whole lot to talk about here, but I guess I'm pretty excited about this just because I really don't like going to the shops.
Yeah, it's boring
I think it's kind of a step that doesn't need to be there, and I know that it will be eradicated one day.
Yeah.
Like, there's really no point. If you can get all your groceries delivered, and I mean, for the most part, people ordering groceries, you're ordering very similar things week to week. You're not changing it up, so you can have a set list of things that you're buying, and if you can get it delivered for free, then that's fantastic. I wonder if they'll raise... I mean, I presume that... I guess it's only for the month, so maybe they will just take a bit of a hit on this, but I guess if they're going to offer free online shopping, they're going to have to raise the prices on the goods.
On the goods, yeah.
And I guess that's probably what they will do, just because it's a bit sneakier, I think. If you offer free shipping and then you just increase the prices of the goods, people might not notice a whole lot compared to you saying, oh, here's a $30 delivery fee. So, yeah, we'll see what happens with that. But,
it sounds like it's more of a marketing ploy than anything.
I think
really.
so, yeah.
Yeah. But, so that kind of rounds out the week of news. I don't think we've got anything else to talk about. So we'll get into the second section of the podcast now. And as you were saying before, we're going to be talking about kind of, with everyone saying, there's a recession coming next year. How many videos on YouTube have you seen where it's just like, recession in 2020, here's what to do kind of thing? They're popping up everywhere. Yeah, we better make one.
Yeah, I don't think I've made one of those recently. Maybe I have. Oh, well, I mean, I've spoken about sort of what some other, like Ray Dalio and what Buffett has sort of spoken about, but yeah, I haven't made the how to prepare for a recession video yet. But you see one pop up and then It does well, so everyone just kind of jumps on it.
Yeah. In the second section, we're going to be talking about kind of not ways that you can predict a recession, because in all honesty, you cannot predict. Well, you might be able to more or less see a recession coming, but when it comes to stock markets going up or down, you can't predict that. Like in the short term, who knows? But we're going to talk about some key, indicators that people or investors use to just keep track of whether markets are overvalued or undervalued, that kind of thing. Because although we can't predict if the stock market's going to go up or down, we can see whether it's kind of like hot or cold kind of thing, if it's really overvalued or really undervalued. And the first one we're going to talk about, this is more of like a comparison in the bond market, right? We're talking about the inverted yield curve. So did you want to run us through the inverted yield curve and tell us kind of how that relates to recessions or what we've seen in the past?
Yeah, so the yield curve is historically been used as kind of this indicator of predicting a recession. It's kind of called the recession predictor by many people.
Yeah.
And so I thought we'd maybe spend a little bit of time explaining what it is, and then maybe I'll talk about what's kind of happened in the past and show you why people think that it's kind of a recession predictor. And I think we may have spoken about this in last week's or maybe the week before's podcast. So if you wanted a bit more in-depth, where I speak about this a little bit more in-depth, then go check out those podcasts as well after this. But essentially, more recently, on March 22nd, the 3-month Treasury rate topped the 10-year yield. So the 3-month yield, the return that you could get on a Treasury bond for 3 months, was higher than the 10-year. And I believe the 2-year and the 10-year, the 2-year passed the 10-year in August, so last month. And that's also another one that a lot of people look at, is the 10-year bond compared to the 2-year bond. So what does it mean if the shorter term passes the longer term? So traditionally speaking, the longer term bonds will offer a higher return than the shorter term bonds.
Yes.
So, and this kind of makes sense if you're giving your money, because essentially when you're buying a bond, you're really loaning your money to someone else and they're going to return it to you in a particular time.
In this case, the government, yeah.
In this case, the government, correct. And if you're loaning your money out, if you're buying a bond that's 10 years instead of 2 years, then your money is out there for much longer. And with that time comes more risk. So traditionally, if an investor wants to lend their money for longer to the government, then they are demanding a higher return. So traditionally, the 10-year will offer a much higher yield than the shorter term bonds, such as the 3-month or the 2-year or the 1 year or anything like that.
I think basically it's just like if you're an investor and you're given the choice, are you going to invest for a month or 10 years, then typically you say, well, in the next month, there's probably potentially not going to be as much that could potentially happen, but in 10 years, there's going to be a lot that could potentially happen. And therefore, if I'm going to lock my money down for 10 years, I want to know that I'm going to get a much better deal than over the next like month or 2 years or that shorter term time frame. So that's why you'd probably normally you'd expect a higher rate of return for locking your money down for longer than for a shorter length of time.
Yeah, and so naturally, most of the time, that 10-year bond will have a higher rate on it, a higher yield than the shorter term ones, the 3-month or the 2-year or some of the other ones. But when this inverts, it essentially means when the curve becomes downward sloping, and that essentially just means that the shorter term bonds are offering a higher yield than the long-term bonds. And it's kind of the reason why it's something that doesn't happen too often is because it kind of goes against intuition. It goes against that logic of the longer our money is being held for, the longer we're foregoing our money, the higher return we should demand. But the reason why sometimes the shorter term bonds offer a higher yield than the longer term is when investors believe that there is more risk in the short term than in the long term. So when investors believe that holding a bond in the short term, in the next 2 years, is riskier than holding a bond that will be 10 years out. And traditionally, it kind of suggests, it kind of gives us a bit of an indication about investor sentiment, what investors think about the riskiness of the markets in the short term. And investors think that the markets are riskier in the short term, it means that they're basically suggesting that they think there's going to be some kind of poor economic condition in the short term, some kind of recession in the short term. So interestingly, there's one of these yield curves, which is called the 10-2 spread, if you want to look it up. And that's the spread, as I said, between the 2-year and the 10-year bonds. And an inversion of this yield curve has always been followed by a recession.
Right.
And which is really fascinating, because it kind of means that it might suggest that it may predict some kind of recession. So on average, it usually takes about 1 to 2 years for a recession to occur after the yield curve inverts. So while it does invert and then a recession follows, it usually takes some time. And a couple of examples. So the last 2 recessions that the US has had. So in 2006, the yield curve inverted, the 10-2 spread. But the recession didn't begin until 18 months later in 2007.
True.
And then the other closest one was in 1998, it inverted, and then the recession came in 2001. So that was almost 3 years later.
Yeah. Right, so it's kind of like, it is historically, I guess, a reliable indicator, but not an indicator that it's going to happen straight away.
Yeah, it's interesting because, as I said, the 10-2 spread inverted for the first time only a few weeks ago, and the markets kind of just shook up a little bit, and it's been pretty volatile in the markets, lots of ups, lots of downs since then. But then again, history also suggests that if it's only inverted just now, then we're going to be still waiting quite a while before a recession hits. Now, that doesn't really tell us anything about what the stock market's going to do, because remember, the stock market can move down before a recession, it could move down after a recession. The stock market can do whatever the hell it wants based on the buying and selling decisions of investors. So what's interesting is that historically it might have taken 2 years, 1 year for a recession to hit after, and for the stock market to go down after the yield curve inverted. Maybe 1 year investors just panic a little bit earlier or a little bit later. So all this is just to say that it's an interesting indicator to follow, but
it's not a direct correlation.
We cannot really predict when a recession is going to happen, and even more difficult, what the stock market is going to do in that event.
Yeah, true. I think it's just, I guess, making that separation between the stock market and, say, the economy. Most times they'll probably be fairly closely linked, but they're not the same thing. So if you do have a recession, that doesn't necessarily mean the market's going to move down straight away, although generally speaking, it probably will. But yeah, because in the short term, the stock market is just based on what investors are doing with the different companies in the market, I suppose.
Yeah, and like the recession indicator, which a recession really just means that there's been, well, the traditional definition of a recession is that there's 2 consecutive quarters of negative GDP growth. So there's 2 quarters where total spending in a country has been negative, it's declined. And
total
really,
production, you mean?
Total production, correct. And essentially, this is kind of a backwards looking measure. Like, it's looking at past spending when it's measured. So it's just further suggesting that there's really no way we can use GDP data or yield curve inversions or anything like that to predict what the stock market's going to do, because if there's forecasts of a recession coming, it's likely the stock market will start to go down already.
Yeah. No, that's interesting. I think, does that kind of round out the yield curve discussion?
Yeah. And as I said, we've spoken about this on a couple of different podcasts. So if you feeling like going on a Young Investors binge, then go back through a couple of the previous podcasts, and we speak about this a little bit further in depth. Yeah.
I think whenever the yield curve inverted, it was in the news of that podcast that week. So find out when the yield curve inverted, and we probably talked about it then in that week's podcast. But yeah, so that's the yield curve. We've got some more indicators to talk about as well. The next one I wanted to talk about was the CAPE ratio. The CAPE ratio, so CAPE just stands for cyclically adjusted PE ratio. And if you look over in America, they've got the most famous CAPE ratio. It's actually not even called the CAPE ratio in America. It's called the Shiller PE ratio. So the Shiller PE in America, it just compares 2 numbers. It compares the current price of the S&P 500, which is the index for the largest 500 US companies, and it compares that to their average it compares the price of the S&P 500 to the average inflation adjusted earnings from the previous 10 years. So that sounds complicated, but really you can basically just think of it as a price to earnings ratio for the S&P 500. So you can then again think of it as you can think of it as a price to earnings ratio for the general like American stock market, I suppose. So typically what we've found is that this number, just knowing what the CAPE ratio or the Shiller PE number is, doesn't have too much relevance. Basically for this number, you need context. So since the late 1800s, pretty much the average for the Shiller PE is what has been 16.65. And that basically just means that the price of the S&P 500 is on average, 16.65 times the earnings of the S&P 500. That's the easiest kind of way to look at it, I suppose. So 16.65 is the average. And then at the moment, it currently sits at 29.86. So, I mean, that seems high. Again, we kind of need to think, well, hey, what does this mean? Basically, what it means is that investors are roughly accepting half the value for money as what they would, on average, accept when they're just buying the American market generally. So, it's, it's obviously, it just shows you that investing right now, if you broadly diversify across the American market, typically, compared to history, you're not getting the best value for money. Yeah. So it seems like the American market, the price of the American market is very high compared to what the earnings are. Yeah. Is basically what it's saying.
Yeah, the way I kind of like to think about any kind of PE ratio, but especially this one, is it kind of tells us about what investors think is going to happen in the future. So if there is a really high PE ratio, so in this case, the Shiller PE is twice as high as its historical average, then investors are expecting earnings to grow much quicker than the average in the future, in the next few years. So it's kind of a good indication of expectations, and expectations of investors about future earnings reaches its highest point. It gets very strong just before there is some kind of recession. So traditionally, prices will kind of start to balloon towards, I think Ray Dalio calls this the bubble stage or something, where essentially people are looking back over the past 10 years and they've seen that the stock market, regardless of earnings, has gone up very consistently and very quickly. And as a result, I'm going to get in and therefore the stock market's going to continue to go up. So people are just getting in because it's been going up. And that is kind of when a bubble forms. That's when this kind of happens, when the PE ratio, the price, just starts to go up way quicker than the actual underlying earnings that the companies are producing.
Yeah, I agree. It's interesting if you look back on history with the Shiller PE ratio, then it's only ever been above 30 at 3 times in history. So what's really interesting is that the times in history where it's been above 30 is 1929, then 1999, and now, well, very, very recently up until now, where it's just dipped back under 30. So if you don't know what those numbers represent, 1929 was the start of the Great Depression, 1999 was the tech bubble, the dot-com crash, and now, what will now represent? Obviously, we don't know yet because nothing's happened yet, but I find it very interesting. It's kind of like what we were talking about with that yield curve before. We can't just say, this number goes over 30, that means recession will happen within the next 12 to 18 months. But it's interesting, you can always look back to history, and any time it's gone over 30, it's just the stock market has come plummeting back down. 1929, 1999, and now. So as I was saying before, historically the number hasn't been able to be propped up over 30 for more than 12 to 18 months. Investors just accept that's kind of like they're just not getting good enough value for money, or I guess what happens is that they're expecting so much and then the stock market can't actually produce what the investors were expecting.
Yeah, the stock market's kind of just like this massive expectation game. It's kind of like expectations slowly rise and rise and rise and rise and rise because earnings have been going up so much in the past, and then expectations get missed massively, and then everyone's expectations are so low. No one wants any stocks. They're expecting no growth in earnings out of companies. And funnily enough, that's probably the best time to start buying. And then expectations start to grow again, and the stock market starts to move up. I think it's Benjamin Graham that said, in the short term, the stock market's a voting machine, and in the long term, it's a weighing machine. So in the short term, it's just a vote of what people think is going to happen in the future. But over the very long term, it's about what the companies actually earn. What weight do they have? What is their actual true value? But it's certainly fascinating that it's so high, and that the only other 2 times have been kind of catastrophic, that it has reached that height.
Yeah. Again, as we were saying before, it doesn't mean that something is going to happen, but it is interesting that history has been an interesting case example for the Shiller PE. So that's interesting. We can move on to the next one as well, if you want to. The market cap to GDP. You want to do that one?
Yeah. So this is another sort of indicator, and it's kind of self-explanatory. It essentially compares a country's total market capitalization, so the value of the country's total stock market, what the price of all the stocks are added together, with the gross domestic product, the GDP of that country. And in the US, again, they have a fancy name. They have a fancy name for all of these indicators.
Yeah, I know, right? Yeah.
Theirs is called the Wilshire GDP.
Yeah.
That's real fancy.
It's basically it's an indicator where the Wilshire GDP, it compares the biggest US index, which is the Wilshire 5000. So that's like, for America, that is like a total market kind of index. And then it compares that to the actual GDP of the United States. So typically what we see is if the number goes above 100%, then the market cap of the Wilshire 5000 actually going up past the GDP of the United States. So typically that's when things start getting sketchy in the market. That's when the market starts getting very overvalued. I learned about this from a book called Invested. That was the book that opened my eyes to this indicator, and it's one that obviously Buffett doesn't really use these indicators because he's more focused on individual businesses, but he's said in the past that he likes to use this indicator just to keep an eye on general market conditions. And typically with the market cap to GDP measure, if you get a measure between 70% and 100%, then generally the stock market's fairly valued. But anytime it kind of strays above 100%, that's getting very pricey. And at the moment, what we find in America is the Wilshire GDP sits at 170%.
Whoa.
So, and giving some context to that number, the Wilshire GDP has only been over 100% twice in history. The first time was in 2000, the second time was in 2008. So, again, we can't use that number and say a recession or a crash is going to happen, but history is an interesting case example where, of course, in 2000 we had the dot-com crash, and then in 2008 that was the start of the global financial crisis. So I find the market cap to GDP a fairly interesting measure as well. But in terms of, I suppose we've been talking about American figures a lot. In Australia, we're not quite as bad. I think I looked up the market cap to GDP recently. It was at about 120% in Australia, and that was using, for market cap, that was using the ASX 300 index, so not quite the whole market like what the Wilshire 5000 kind of represents. But having said that, the ASX 300 accounts for is it 85% or 88% of the Australian market cap? I can't remember which one it is.
I'm not sure,
but it's up there. It's high. So 120% for Australia. Obviously, it's not as bad as 170%, but it's still pretty pricey overall.
Yeah, I hadn't heard of this indicator until you kind of brought this to my attention. It's certainly interesting. It seems as though this kind of indicator has been. It kind of looks as though when I've looked at the chart, it's kind of just gone up over time as well. So I find that interesting as well.
Yeah, I've heard an interesting argument that I haven't really thought about this too much, but the argument that I heard was that the market cap to GDP might not be as relevant as what it once was because of globalization. So if you look at, say, the US, you get most of the weight of the US markets is held in those big companies like, your Apples or your Amazons or your banks or whatever, or Facebooks and Googles. But a lot of those more techie, big tech companies, they're not just contributing to American GDP. They're earning a lot of money overseas as well. So I've heard that argument. I'm not sure how that kind of plays into it, how much significance that has. Does that kind of make sense for you?
Yeah, that's the initial thing that I thought when I saw this indicator, but I mean, I haven't really sat down and thought about the economics of that argument too much, but it kind of makes sense. Like the price of a tech business, you're paying for a business that's producing, in some cases, the majority of their earnings overseas rather than in the US. So yeah, that could play a role. I'm not sure. I'd have to think about that.
We'd have to do more research on it. The Young Investors Podcast, your one-stop shop for everything investing, but we'll have to do a bit more research on that. Anyway, so yeah, that's kind of the market cap to GDP measure. I just thought I'd chuck that one in there because I've heard that that's the one that Warren Buffett likes to track a lot. But yeah, I'm no expert in it, I should say. Anyway, with that said, I guess the other way to look at things is just from your own individual investing to try and see if there might be a recession ahead or a market crash imminent or something like that. You can also just have a kind of gain experience through looking at the businesses that you look at. Say if you did some, I guess company valuations on a lot of these big American companies that hold a lot of the weight, and you're seeing like no matter what business you're valuating, you can see the margin of safety price or the current share price is like 3, 4, 5 times what the margin of safety price is. That can also be an indicator. If you get consistently high results where you're not finding any good discounts on stocks, then that can also just be a general indicator as well that maybe you're in a very hot market.
Yeah, and I mean, this is kind of something that we would probably look at more closely because when we're buying individual companies, what I care about at least mostly is what kind of returns I can get. What's the price compared to the earnings of the companies that I'm actually going to be investing in? Which is kind of like a small basket of companies that I think I can understand quite well. And yeah, I mean, when you're looking at those, at least in my case, many of them are quite expensive. Some may be below their intrinsic value or slightly above, but in many cases the return that they offer just isn't substantial enough to make a solid investment into those companies. And it kind of just indicates that, as I said kind of earlier, that many investors have big expectations of companies. Like a lot of these businesses are priced to grow at 15, 20, 25, 30% per year for a 10-year period from now, which is a huge expectation. Might happen. It's just an expectation. It doesn't mean that I'm saying that they're wrong or that they're right, but it's a huge expectation, whereas there are other times where expectations are so low that you can get those margin of safety prices. The expectations are low, and we do the research and we find out that businesses can quite likely offer a better growth prospect than what expectations are, but that's really not what we're seeing at the moment.
Yeah, I always look at these valuations and you're seeing like some companies which have been growing well in the past, but you're seeing the valuation which is like 4, 5 times intrinsic value. And I just think like if investors are investing in that company right now, they're settling for like what is likely to be such a low return. Like I go back to the example before of what we were talking about. It's just like with the Shiller PE, investors are settling for about half the value for money is what they would normally get in average market conditions.
It's crazy.
So I guess I agree with you in that sense, is that you look at what these companies might be able to produce and what sort of return you can get, and when you model it out and you realize that actually at these prices you can't really get much of a good return, even if this company grows at a decent like 10-15% rate, and to get your returns they have to grow at like 30 or 40% year over year for the next 10 years. Like it's pretty crazy, and you do kind of get that sense just from doing this time and time again on some of these bigger companies out there. You're just like, wow, things are hot at the moment.
Definitely.
Things are pretty pricey.
Yeah, I mean, as value investors, we want to keep our future expectations quite low and still be able to find businesses with high returns. And yeah, it's getting to the point where the expectations are really, really high. And yeah,
it's a bit demoralizing.
Yeah, Definitely is. It's sad.
It's like I just want some opportunities to invest. I'm getting so few. It's like, come on. But we must stay patient.
Yeah.
Patience
and discipline is everything.
Yeah, exactly right. Too right.
No, but that kind of wraps up the middle section of this podcast. I hope you guys got some value out of that. If you have any sort of topics you want us to discuss, something you find difficult in related to investing or finance, then feel free to leave it as a comment on the YouTube video format of the podcast, and we can check out those as well. But for now, let's get into the final section and do some Q&A questions. So I'll pose this first one to you, Brandon. Where do you find your data for stock analysis? Are there any platforms worth paying for that make the process easier, like simply Wall Street?
I get a lot. Well, I really like Yahoo Finance. I can sit on a company's page on Yahoo Finance for ages and just look at the ins and outs, because it gives you like those summarized 4 years of like balance sheet, income statement, cash flow statement data, and gives you all the ratios and all that sort of stuff, the growth rates, the analyst expectations. So there's a lot to kind of dive in with Yahoo Finance, and I find I can get like a reasonable picture of a company just by kind of analyzing it through Yahoo Finance. So I do use Yahoo Finance a lot. I also use the Rule 1 toolbox, which is a paid subscription. I think it costs like $30 a month or something, so it's pretty pricey. But because the method that I follow is basically Phil Town's method, his subscription service thing, his toolbox subscription, is basically just an automated calculator of all of the moat numbers, all of the management numbers, the margin of safety, that sort of stuff. I always do the margin of safety, the valuation myself. I think that's important for everyone just to do the valuation part themselves. But if you want a quick kind of guide to, earnings per share growth rates and cash flow growth rates, return on invested capital numbers and all that sort of stuff, then the Rule 1 toolbox I found to be fairly useful. And I chuck it in my videos every now and again if I'm breaking down an individual stock. But apart from that, all the info that I need is basically hidden within the conference calls and the quarterly reports and that sort of stuff.
Yeah, I'm fairly similar. There's a website that I use called quickfs.net. That's good for getting all of the 10-year data from the income statement, balance sheet, cash flow statement for US companies only, though. So there's nothing there for Australian companies, unfortunately.
What was it?
Quickfs.net.
.net.
Yeah.
Okay.
So you need to make an account, but it's free, and then and then you can get all of the data there for US companies, and for the most part, it's pretty accurate. But yeah, like you said, I mostly get information from the annual reports and the conference calls and the quarterly reports and the investor presentations, everything that's basically on the company website in the investor relations tab. Basically everything that the company provides you in terms of data is most of what you need.
Sweet.
As long as you're kind of willing to do the digging and go and find it, then it's all there.
Yeah, I would agree. Yeah, so there you go. So yeah, mostly, I don't know, you don't necessarily, I don't think you need to pay for any subscriptions or that sort of stuff. They can just increase your efficiency a little bit. But yeah, they're the ones that we use. All right, let's go on to this second question. As an investor in businesses, how do you take advantage of stocks that are heavily shorted? Or do you take advantage of stocks that are heavily shorted? Does it influence your investing, whether a stock is shorted or not?
Yeah, I wonder if this person means take advantage as in short it as well, or do they mean if it's heavily shorted, the stock price is likely depressed and therefore you can get in?
Get more,
in terms of shorting, I never short stocks at all. So
yeah, I've never done it either.
Yeah, there's just no reason for me to really short a business. I don't think that I would be very good at predicting which businesses are going to go bankrupt. It's much easier to predict that businesses that have been great in the past are going to continue to be great. So that's a lot easier to do than shorting a stock and betting that it's going to go bankrupt in the next year or so. But in terms of looking at businesses that are heavily shorted to buy their stock cheap, it doesn't really, I don't really consider it too much. If a stock is heavily shorted, then that means that a lot of people believe that the company is going to go very poorly in the short term over the next few years, or think that it's going to go bankrupt. So you definitely want to look into that and understand the risks that you're taking when you're making an investment. Because if people are shorting the stock, it's likely that they've done their research and that they really believe that there's going to be some bankruptcy or something happen to the business. But other than that, if it's a great business and if it's at a great price, then what other people are doing with the stock really doesn't matter to me, as long as it's at a price that I like. And for the most part, if you're going to be getting these really great deals, you're going against the consensus anyway. So you're betting that the stock is going to grow at a particular rate, while everyone else thinks it's going to grow at a substantially lower rate. So you kind of have to bet against everyone anyway if you're going to be outperforming the market.
Yeah, I agree.
That's it. Yeah.
Well, I mean, you kind of just we invest very similarly, so we end up covering it very similar. Like I don't really follow whether a stock has been heavily shorted, and like what you're saying, if it is heavily shorted, then you do want to know why it's being heavily shorted. But if like some shorts are obviously short-term focused, so sometimes they just think that maybe it'll go down in the short term. They want to try and capitalize on that. But of course, sometimes the short-term issues can give you buying opportunities if it doesn't really affect the business in the long run. If you're planning on holding a stock for like 10 or more years, then sometimes it doesn't like if you understand why that stock's being shorted, if you can realize that that's not going to affect the company in like 10 years, then it might present a buying opportunity. But you might also get the added bonus of a short squeeze. You never know. Where basically where a stock can just surge up thanks to the old short sellers losing money, which I don't mind. I don't mind seeing a short seller lose money,
especially in a great business.
Yeah, it's just like, suck it.
Anyway, so we've got the last question here. I'll pose this to you before we wrap up this podcast this week. So this question is, are there any websites that track or list the moves that institutional investors make?
I don't know, because I don't really follow it too much, so I don't know if there's any websites that will show you exactly what the institutional investors are doing, but you can definitely track the flow of institutional money, and that's through the indicators that we talk about, like the MACD or the stochastics. So the MACD literally just tracks the flow of buying and selling pressure, so the flow of money into and out of large companies, and then the stochastics is kind of judging the 80 and 20% lines for periods of being overbought and oversold. So, and you can follow these indicators just on Yahoo Finance for free. So basically you just go into a particular stock, you click on the interactive chart, and then in the top left you've got an indicators tab, and you can add the MACD and you can add the stochastics, and you can track the flow of money in and out of stocks by the big institutional investors, because remember, they have to move very slowly, so you can see what's happening over a period of time as they all play the same game together, which of course is what gives us our advantage as the small investors. But yeah, I'm working on redoing my stock market investing for beginners course, and I actually talk about these indicators in much more depth. It's currently not available, but if you're listening to this in the future and you wanted to check it out, feel free to do so, to be linked on my channel or something, because we are going very in depth with the indicators in the course as well. So if that's something that you're interested in. But what do you think? Is there anything that do you follow the institutional investors at all?
No, not really. I mean, I know that Phil Town in his first book, Rule 1, spoke quite a lot about the MACD and the stochastics and this idea of trading, sort of still sticking to value investing where we're finding great businesses and buying them at the right price, but then also adding on this other aspect where you're actually also trading in and out if you can sense or sort of see the movements of what institutional investors are going to do, which really move the market for the most part because they have most of the money. So no, it's not really something I do. I generally just stick to looking at the businesses themselves, and if it's at a price that offers me a great return in the future, I'm happy to buy it. And if that means that then institutional investors continue to sell and I'm down 50% on a position before it continues to go up, that doesn't really bother me, because I know that the price I initially paid already offers me a good return. The fact that it's come down further by institutional investors pushing it down and selling the stock just means that I might have a bit more of an opportunity to add some more at an even better long-term return. So, I don't really look at this too much.
Yeah, but, we're more the stockpilers now.
Yeah, I think that's a good way of describing it, and it's a good way to wrap up this week's podcast. Thanks everyone for listening, as always. And as I said earlier, if you have a question or if you have a topic you'd like to see us cover, then head over to the YouTube version of the podcast at youtube.com/Hamish Hodder and just drop a comment there, and we grab all of those comments and chuck them in next week's podcast. But as always, thanks, Brandon, for joining me.
It's all right. It was good fun. I think that was a good podcast. Hopefully the listeners got some value out of it. And yeah, like we were saying before, like Hamish was saying, just if you want us to cover a particular topic that you're interested in to do with finance or investing, just let us know in the comments, and we can do up a podcast on any topic that you guys want to hear about. Yeah,
and that's it for this week, guys. Thanks everyone for listening, and class dismissed. I'm gonna start that. It's gonna be
class dismissed. That's like Phil Town when he finishes his videos. Yeah. He's like, now go play.
Yeah,
it's like,
we need.
What am I,
like
a child?
We need something like that. Class dismissed.
All right. Yeah. All right, little Jimmy, off you go. Go play in the sandbox. It's kind of like it can sound a little bit like condescending.
Yeah.
It's like, that's it for this video. I'm super rich. You guys go and figure out how to do it yourselves.
So true. So true.
Nah.
No.
I love Phil Town though. We got to get him on the podcast. God damn it.
We'll get him on.
It's just so sad that his management, what do you call him? His PR team or whatever. They weren't interested, but that's alright. Yeah. We'll keep trying. Anyway. We're rambling. Bye.
See you guys.